Every few years, the same thing happens in crypto. Prices grind sideways while nobody's paying attention. Then they explode. Everyone you know suddenly has an opinion. New coins fly, and then, right when it feels unstoppable, the whole thing rolls over and bleeds for months. It looks like chaos. It isn't. It's a cycle, and it has repeated in the same four phases for as long as this market has existed. In the next 10 minutes, I'll show you those four phases, the psychology that drives each one, and why 2026 is quietly breaking the one rule everyone thought was unbreakable. Quick note first, this is education, not financial advice. Nothing here is a prediction or a signal to buy or sell anything. It's how the machine has moved historically, so it makes more sense the next time you watch it happen. A market cycle is just the round trip a market takes from quiet to euphoric and back to quiet again. In crypto, it tends to be dramatic because the market is young, emotional, and open 24/7 with no circuit breakers. Analysts split that round trip into four phases: accumulation, markup, distribution, and markdown. Accumulation is the bottom, when almost nobody cares. Markup is the climb, when price trends up and belief comes back. Distribution is the top, when everyone's excited and early buyers quietly start selling. And markdown is the fall, when it all unwinds. The names sound technical, but each one is really just a description of how the crowd is feeling. Price is the scoreboard. Emotion is the game. Keep that in mind, because the phases only make sense once you see the psychology underneath them. Let's walk through all four. Phase 1 is accumulation, and it's the phase nobody enjoys living through. It starts after a brutal decline. Price stops falling and just goes flat. Volatility dries up. The headlines have moved on, the influencers who were loud at the top have gone quiet, and most people have written the whole thing off. On the surface, it looks dead. Underneath, something else is happening. Experienced buyers start accumulating slowly in small pieces without pushing the price because the last thing they want is to wake it up. This is the phase of maximum boredom and, historically, maximum pessimism. Sentiment tools sit at extreme fear, and that's exactly why it matters. The accumulation phase is where the next move is quietly built, long before anyone believes in it, but you almost never recognize it in real time because everything about it feels like the market is over, which brings us to the phase where that changes. Phase 2 is the markup. Price breaks above the range it's been stuck in, and for the first time in a long time, it starts making higher highs and higher lows. That's the signature of an uptrend. Early on, almost nobody trusts it. People who watch their bags bleed for a year assume it's a fake out and sell into it. But the trend keeps grinding up, and slowly the mood flips from disbelief to hope, then from hope to confidence. Volume comes back, media coverage returns, new money starts arriving, and that new money pushes price higher, which pulls in even more people. That's the feedback loop that defines a bull market. Rising prices create optimism. Optimism creates buyers. Buyers create rising prices. Near the end of markup, logic takes a backseat and a feeling takes over that everyone in crypto knows by name: the fear of missing out. And that fear of missing out is the bridge from the markup phase into the most dangerous phase of the whole cycle. Phase 3 is distribution, and it's the sneaky one. Price stops making clean new highs and starts chopping sideways at the top. Violent swings up and down that go nowhere. Sentiment, though, is euphoric. This is peak excitement. The news is all-time high headlines. Everyone's a genius, and the people who bought at the bottom are now being sold to by the very same people. That's what distribution means. Early buyers distributing their coin to late buyers, handing the bag over while the mood is loudest. The tell isn't the price, because price is still high. The tell is that price stops going up while enthusiasm keeps climbing. When the crowd is most certain it can only go higher is historically exactly when the smart money is heading for the door. And once enough of them are out, there's nobody left to hold it up. Phase 4 is markdown, the fall. It usually starts slowly, a dip that looks like every other dip that got bought. But this time, it doesn't recover, and the lower it goes, the more the psychology flips from greed to fear. Hope becomes denial, denial becomes fear, fear becomes capitulation, the point where people give up and sell just to make the pain stop. Volume on the way down is heavy. New money stops arriving. The coins with no real substance fall the hardest, and some never come back at all. It feels like the end of crypto, and every cycle a new wave of people are convinced it is. But look at where we are on the curve. Markdown is the phase that flattens out. Sentiment bottoms, price stops falling, and the whole thing quietly resets into accumulation again. The end of the cycle is the beginning of the next one. That loop is powered by one engine, and it's worth understanding on its own. Here's the uncomfortable truth about market cycles. The chart isn't really about coins, it's about people. Markets repeat because humans react to opportunity and danger in almost the same way every single time. When price rises, we feel optimistic. Optimism makes us buy. Buying pushes price higher. Higher prices make us even more optimistic. That's the upswing, self-reinforcing until it becomes crowded and euphoric. Then it runs out of new buyers, tips over, and the exact same loop runs in reverse. Falling prices create fear. Fear makes us sell. Selling pushes price lower. Lower prices create more fear. Greed builds the top, fear builds the bottom, and both feel completely rational while you're inside them. This is why sentiment tools like the Fear and Greed Index exist, not to predict anything, but to remind you that when everyone around you is greedy, you're probably late in the cycle. And when everyone's terrified, you're probably early. Cycles repeat because human nature doesn't. That part never changes. What is changing in 2026 is the timing. For most of crypto's life, there was a clock behind the cycle. The Bitcoin halving. Roughly every 4 years, the new supply of Bitcoin gets cut in half, and historically, a bull market followed within a year. Then a peak, then a long bear. 4 phases, 4 years, like clockwork. People built entire strategies on that calendar. But the clock is starting to slip. In the last cycle, Bitcoin made a new all-time high before the halving. The first time that had ever happened, which isn't supposed to be possible if supply is the main driver. And the drawdown that followed the last top was far shallower than the brutal 80% crashes of previous cycles. Why? Because the market grew up. Spot Bitcoin exchange or traded funds now hold enormous amounts of demand. Their assets crossed $100 billion, and that demand swamps whatever the halving does to supply. Institutions, regulation, and macro policy now move this market as much as any 4-year clock. Bitcoin's correlation to the stock market has climbed. So the honest answer to is the 4-year cycle dead is this. The 4 phases are alive and well. Accumulation, markup, distribution, markdown still describe reality. But the 4-year timing is fading as the driver. The shape rhymes. The schedule doesn't. Anyone selling you an exact date is guessing. So how do you actually tell where you might be without fooling yourself? You don't use one magic indicator. You triangulate a few honest ones. First, structure. Is price making higher highs and higher lows or lower highs and lower lows? That single question tells you markup from markdown. Second, sentiment. Are the people around you fearful and bored or greedy and euphoric? Extreme readings in either direction have historically lined up with turning points. Third, breadth. In a real markup, strength spreads out across many assets. Near a top, it narrows and gets speculative and silly. And fourth, new money. Is fresh capital and attention arriving or leaving? None of these predict the future. They just tell you which phase the crowd is behaving like it's in, and that's the whole point. You're not trying to call the top or the bottom. You're trying to not be the last person to realize which phase you're standing in. Manage risk to the phase, not to your hope. One last piece most cycle explainers skip. None of this works without liquidity. A phase change isn't just a mood. It shows up in the order book. In a healthy markup, books are deep, spreads are tight, and big trades absorb cleanly. In a markdown, liquidity evaporates, spreads blow out, and the same sell order that barely moved price at the top now craters it, because there's nobody on the other side. That's why the falls feel so violent. It's not just fear, it's fear plus a thin book. This is the layer we work in at EchoTrade. As market makers, we provide continuous liquidity for tokens across more than 90 centralized exchanges. So there's a buyer and a seller on the book through every phase of the cycle, not just the easy ones. We don't control the cycle. Nobody does. But healthy liquidity is what keeps a market functioning while the cycle does its thing. So here's the whole thing in one breath. Crypto moves in 4 phases: accumulation, markup, distribution, markdown, driven by the same loop of greed and fear every time. The phases are remarkably consistent. The timing, the old 4-year clock, is loosening as exchange-traded funds and institutions reshape the market. Cycles rhyme, they don't repeat, and the moment you're most sure this time is different is usually the moment the pattern is about to remind you it isn't. Understanding the cycle won't tell you the future, but it will stop you from being surprised by it. And again, this was education, not financial advice. If you're building a token and you want it to have deep, healthy liquidity through every phase of the market, that's what we do at EchoTrade. There's a link below for a free consultation. If this made the market make a little more sense, subscribe. We break down how crypto really works, one piece at a time.